Joining me now to provide more insight on the day's market performance is Makwe Masilela from Makwe Fund Managers. Makwe, thanks so much for your time this afternoon. So, green screens all around. We are seeing that sell-off fizzle out. Should we take this as perhaps a relief rally, or are investors just bargain hunting at this point?
I think it's more of a cautious rally more than anything, and hopefully it's not a dead cat's bound because the way it is, nothing has changed much. Whatever made us go down since Thursday is still in place. And I think it's getting worse when the guys are coming with tit for tat, especially between the US and China. And you look at the guys who are trying to negotiate, you don't really make a significant dent when it comes to global trade. And for me, I think sanity ultimately will prevail, and maybe we'll get a real relief rally if it's not this one. But because I strongly believe that between the two guys, US and China, they can say whatever they want to say. The big question is, can they really afford it? And I don't think that we can afford those kind of tariffs going forward. And I think they're all using this as a bargaining tool to get the others to come to the table to see how can they address this whole thing about the trade deficit, because none of them can afford this. But yeah, let's just celebrate the evergreen that we see, especially after losing 3 loans locally, internationally. We might as well share this up to them.
So yes, we are grateful, but that brings me to my next question then. Can it get worse, Makwe? I mean, you read headlines here. You mentioned as well that markets have wiped out trillions of dollars. We also read headlines saying that markets haven't been this low since COVID. So could we see even further weakness down the line?
I think this tit for tat, if it continues between US and China and it gets to be extended, and also we've seen the European Union, responding in a very decent manner. If Trump doesn't take that kindly and also start escalating the tension between now, not only between themselves and China, but also in the likes of the European Union, I think we can get worse.
How concerned are you about the growth picture, Makwe? I mean, we have big banks. I think Goldman Sachs today raised their odds for a U.S. recession to 45% from 35%. Markets are also pricing in even further rate cuts from the Fed. It does seem like, those growth jitters are making their way through markets.
They are, definitely, and it all depends on how long this thing gets to be extended, and also what is it that the individual countries will be doing to try to stimulate their own economies. Look at China themselves. They have already started telling Shin that, guys, you don't have to move your production out of the country. We expect the likes of China to try to stimulate the economy so that at least it can start boosting some local demand. We expect other countries as well to do the same, that here we are, we've got this situation, and bearing in mind that short term, we don't know where to diversify, but long term, you'll find other markets other than the US. So I don't think it's a blanket thing that it will definitely be that worse. I think for me, it will be more of what are we doing, and are we doing that speedily enough to make sure that we get other markets? What is it that we're doing? Try to stimulate our own economies, deal with our own issues. So I think it can go either way. And for me, it's too early to start calling it that we might get a recession or not.
You talk about stimulus measures there that could possibly boost growth. Do you think that markets are maybe, getting ahead of themselves with pricing in 4 to 5 rate cuts from the Fed?
I think we are, and I think that's the markets, is typical of the markets. They try to, you swing your hand, that let's ask for something, let's see whether we'll get it or not. I mean, think about it, the guy just on Friday, and Friday happened after the Liberation Day in the US. So knowing the tariff that will be imposed, he still maintained that the guys, they themselves are not in a rush to cut interest rates. So to start talking about 5, I think that's too much.
That's a lot. I mean, we are hoping for them, but I really doubt we'll get that many rate cuts. Let's look at the U.S. tech sector for a second. Now, that sector really being beaten from about the beginning of the year with the emergence of DeepSeek. But what I found interesting of late with the recent rout we've seen is Apple's performance, Makwe. And you know, with Apple's ties to China as well, there are now expectations that China could possibly raise prices of their iPhones, as most of their iPhones are made in China. What have you made of that move? And you know, there's also been talk that China could possibly even move production hubs to India.
Yeah, it's true. And I think we also saw a report that since last weekend, a lot of American consumers have been buying more of iPhones in anticipation of the tariffs. So they might as well will get them at low prices. And now you also, when it comes to tech as well, you know, European Union, they can still impose some funny tariffs when it comes to US tech themselves. So that will hurt them, you know. And that is why I've been saying that none of these two countries can afford this kind of tariffs. You drill down to stuff like that. That for now is ego, stuff like that. But at some point, sanity has to prevail, and probably maybe their PR guys already are working on a way of how we face when they start talking, because we cannot afford this. They themselves cannot afford this. But yes, those are the short-term impacts that we'll see the likes of Apple having that negative drop, stuff like that. That is just too unfortunate for them. But hey, remember, you always have paper gains and paper losses.
Yeah.
Let's hope there's paper loss.
All right, Makwe, let's just hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
Yes, so we look at companies that are not really exposed to the sort of tariff tumult, and their key asset is Boxer, which they still own 65% of, and the share price is significantly lower than prior to the Boxer listing. The Boxer listing has done very well. The business continues to do well, very well positioned. So by buying Pick n Pay, you get access to the Boxer investment story plus optionality around the Pick n Pay turnaround. And really, we think that can gain a lot of traction. And as a basket, it looks attractive that you get both irons in the fire when you buy Pick n Pay.
Yeah, so I think it's difficult for me because I do see a lot of opportunities, specifically locally. Looking at some of the bank valuations, for example, they look very compelling. But you know, I do feel like the sentiment is still quite negative among locally as well as offshore, and there could be further pullbacks. In such a case, then perhaps some dry powders would be quite handy, specifically to buy some of those quality stocks we referred to earlier. But if you do have some exciting opportunities in your portfolio, perhaps do some small top-ups. But in a way, I do still expect some downside just because valuations were as high as it was in the US, and it's probably more downside. So yeah, cash for now, but looking to employ soon.
So Alex, staying safe, holding on to his cash, and Rowan picking Pick n Pay. What have you made of those moves, and you know, staying safe in this kind of environment?
Definitely, you know, food retailers continue to be attractive, and Pick n Pay, at least through Box, they've got an exposure to the middle to lower LSM. But if I have to being forced to choose between the retailers, food retailers, I think I'll go with ShopRite instead of Pick n Pay. But generally, as a sector, it's not bad. Cash, it's okay, but I don't think 100% cash. You know, I'll maybe split it into 50-50. But fortunately, he said he's looking to start deploying it very soon, because what rates are you getting when it comes to cash as well? And we just mentioned that people are expecting interest rates to go down. So that might affect your return that you'll be getting on your cash if interest rates to go down.
All right, so where are you seeing opportunity at the moment? What's your stock pick, Makwe?
I'll go with Anglo-American Platinum. We know that platinum from South Africa have not been part of the tariffs imposed by the US. We know that the US cannot get platinum from Russia because of what's going on. And we know that the guys have imposed tariffs when it comes to motor vehicles coming out of other countries, meaning they have to check up their own production when it comes to motor vehicles, and probably that will lift the demand when it comes to platinum. And the likes of Anglo-American Platinum, I think, with a dividend yield which is around 19, much better than their peers, and not a dividend yield, the PE of 19 is much better than their peers, and a dividend yield of just under 12, which is the best in the sector. I think I'll go with Anglo-American Platinum.
And Makwe, are you not concerned about the 25% tariff on vehicles and components, and how that could then weigh on the PGM price?
I'm not, especially if you look into the US one, because remember now guys will struggle to sell into the US. So who's gonna meet the US demand? It means local production must go up. And for that as well, you still need platinum. And platinum itself coming out of the country is not part of the tariffs that are on both imposed. So I think those companies they stand a chance to benefit. And as I said, you cannot buy from Russia, given the sanctions that have already been imposed on Russia.
Makwe, thanks so much for your time and just taking us through trade at midday. That was Makwe Masilela from Makwe Fund Managers.